How is everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. Today, I wanted to talk about some of the challenges that come with growing your commercial real estate portfolio. I saw a great article in Bank Director that I wanted to bring in and share with everyone. So this is called Commercial Real Estate, or CRE, Growth Brings Added Challenges. And this is written by David Ruffin. And I thought this article was really good and really interesting. So it says, at Bank Directors 2021 Acquire or Be Acquired Conference, investment bankers propounded a persistent theme to the commercial banking counterparts. Get your loan growth up. It's at the heart of your bank's valuation and pricing model or modeling. Organic loan growth at community banks has been sluggish for a couple of years, excluding the impact of historic pandemic stimulus programs. This growth rebounded in 2021 and 2022, but it was almost entirely driven by a familiar source, commercial real estate, or CRE. Since the 1990s, various market dynamics and talent considerations have led community bankers to increasingly favor CRE as their loan product of choice. While the growth problems seemed resolved, complications arose. Smaller banks emerged as the sole segment, banking or non-banking, of the U.S. economy driving CRE growth. By June of 2023, the four federal regulators issued joint enhanced management guidance in response to what they perceived as a growing systemic credit risk for the industry. So here we have a really good chart here. This is called Smaller Banks Reserves Lag Behind Rising CRE Exposure. So what we have here in this, it's kind of broken down by the first quarter of 2023 versus the first quarter of 2024. We have at the bottom here what they call Quick Analytics Community Bank Index of true community banks. That would be banks that were 10 billion and under. And then it has what they call the non-QCBI, includes larger banks with assets over 10 billion. So, and what we can see here is that the CRE loans basically for smaller banks between the first quarter of 2023 and the first quarter of 2024 remained pretty much stagnant at 31.11% versus 31.06%. Whereas for larger banks, commercial real estate loans actually decreased just a little bit, going from 10.05 to 9.89%. At the same time, reserves, so basically loan loss reserves, stayed about the same again for community banks, not really moving very much, going from basically 1.25% to 1.22%, whereas at the larger banks, they have increased their loan loss reserves, going from 1.83% to 1.93%. So again, community banks staying kind of stagnant with their loan growth, but also staying stagnant with their loan loss reserves, as they have not really seen too much in the way of delinquent loans as to this point, as larger community banks have kind of, reduced their number of commercial loans, but they've also increased their loan loss reserves. I'll get into that a little bit more in a minute, though. So, okay, and then here, so likewise, in post-COVID era, the allowance for credit losses, or ACL, has followed different trajectories for large and small banks, as shown in the chart above. Again, large banks, while reducing their CRE exposure, have increased reserves. In contrast, the growth to reserve ratio at smaller banks has remained flat or inverse. While credit quality metrics generally remain healthy, challenges are clearly increasing. They're exacerbated by inflation, rising interest rates, and pandemic-induced paradigm shifts, such as reduced office space usage and the impact of decreased business travel on the hospitality industry. There is no longer doubt that regulatory scrutiny on safety and soundness is increasing, particularly for community banks with strong CRE dependence. Regulatory orders to management and boards are on the rise, with a common focus on credit processes rather than transactional credit deterioration. So, what should community banks do if they are becoming a larger target for regulatory scrutiny? They can improve their credit processes, especially the awareness and oversight of the CRE loan portfolio. For all banks, and particularly those continuing to grow their commercial real estate portfolios, consider the following strategies. And there's a number of items here. So we have deepen your CRA concentration assessments. We have recognized that the risk is more dimensional. Supplement the bank's CRE lending defense strategy with objective third-party data. Improve macro portfolio data analytics, embrace multiple stress test modes, expand loan review, update loan policies and servicing protocols to reflect the current environment. Integrate enhanced CRE oversight with strategic and capital plans and risk appetite statements. So, a lot to touch on, a lot to go over there. So I'll start with the first one. So deepen CRE concentration assessment. So basically, don't focus solely on the broader 100, 300 percentages of risk-based capital guidance. So for anybody who doesn't know kind of like the 100, 300 percentages, that's a different way of looking at your portfolio versus capital levels and what's your concentration of commercial real estate there. And, once you begin to bump up against or go over those 100 and 300 levels that are not, it's not hard and fast. It's not like the regulators are going to come in and kill you if you're over those ratios, but they're not going to like it. They're certainly not going to like it. But it's basically, they're basically if you are in that area, I would say they're probably going to take a harder look at your lending type. Like, what do you like? In other words, are you overweighted in a certain category, like multifamily or office or retail? Kind of they were going to dig a little deeper on kind of what's going on there. And then it says here, like, instead, emphasize and analyze the various CRE loan product subsets that comprise concentrations. And that's exactly it. I think that, you should absolutely be looking at and breaking down your portfolio based on like what are the different percentages in the different categories. Are we heavier in one area that we are in another? And then that should drive part of your strategy for basically like, hey, do we need to cut back in this one area and maybe start to lend more over here or beef up over here, or however that is that you kind of try to even out your portfolio mix, as it were. Recognize that the risk is more dimensional. So understand that risk encompasses more than just the borrower's traditional repayment capacity. It also includes the economic and supply and demand profile of a bank's CRE lending footprint. You can always put in, more data or analysis into your credit underwriting, right? You can always, you can benchmark different industries. You can go in, you could put in more different demographic information if you wanted to. You could go and get more, industry specific reports on commercial real estate, maybe something from like CBRE or Reese or one of the other, maybe CoStar or somebody out there, get some reports that can kind of back up what you're thinking or what you're looking to do there. Now, here's an interesting one. Supplement the bank's CRE lending defense strategy with objective third-party data. So I think that this is where you got to be a little careful. Use reputable sources such as the Atlanta Federal Reserve CRE Market Index and subscription-based services like Vertical IQ for diverse industry and regional metrics. So again, kind of what I was saying, but I'm also thinking that you got to be careful a little bit. Like, in other words, say that you asked a third-party vendor to kind of do an outside analysis of your commercial real estate portfolio. Not that that's a bad thing. That could help you, but it could also, if you're relying too much on that, and if you're not doing kind of analysis yourself to back up what that third party gave you, you might get a little bit of pushback on that. So again, I would just be a little perhaps cautious with that one. And then let's see here. Yeah, multiple stress test models. I think that would, that can't ever hurt. Expand loan review. Loan review is a critical line of defense in reducing uncertainty and identifying emergent hotspots of credit problems. I guess that depends. I guess it depends on what you're currently doing in terms of loan review. Are you looking at your credits every year? Are you not able to look at them every year just because you have a large loan portfolio? I mean, maybe if you have a manpower issue there, are you automating some things and maybe the automated system is renewing all of your lines of credits. So, you know what I mean? And maybe you could look a little closer at some of those things. I think it depends on just how you're running your shop and what you're doing there. So, and And then integrate enhanced CRE oversight with strategic and capital plans and risk appetite statements. So most importantly, enrich communications with and participation by bank boards. Efforts to improve CRE risk management often go unrecognized if they're not documented in board minutes. Yeah, I absolutely agree with that. I mean, I think you should be updating, especially, I mean, if you're a community bank and the majority of your assets is held in commercial real estate, regardless of what segment it is, I mean, I think you should be doing board reports every year where you're kind of breaking that down. You know, where are we most heavily weighted? What are the categories that we're big in and not so big in? You know, what's the breakdown between investment versus owner occupied properties? I mean, you should absolutely be digging into that and breaking that down so that your board has a very thorough understanding of where the bank's, you know, money is being invested in those assets. So, but anyway, I hope this, and then, and it closes out by just saying here, you know, particularly in this environment, a bank needs to write its own credit risk script before a regulator does it for them. You know, again, very good advice. So again, I hope this is interesting. I mean, I think if you're again looking at or considering your commercial real estate portfolio and wanting to grow it more or thinking about different things to do, I hope this was a good video for you. But I'll wrap it up with basically, if you like this video, please make sure to like, share, and subscribe. That always helps the channel. Please leave your comments down below. And remember, you can find us on YouTube, Rumble, and all major podcast platforms. And I will be back again real soon. Thanks a lot.